Today we're talking about ULTY ETF. And honestly, there's been a lot happening around this fund. If you've been following it for a while, you probably noticed that something felt different recently. And yes, things did change. Not in a scary way, but in a way that makes sense once you understand how these types of ETFs are built. So let's break it down as simply as possible. The first big change everyone noticed was the reverse split. This was the main update that got people talking again. A reverse split is basically when the fund takes all the existing shares and combines them into fewer shares without changing the overall value of the investment. Your share count goes down, the price per share goes up, but the total amount you own stays the same. A lot of people get nervous when they hear about reverse splits because they think it means something is wrong. But with funds like ULTY, it's actually not unusual. These types of ETF pay frequent distributions, and every time they do, the share price gets pushed down a little. After a long period, the price can start looking messy or too low on the chart. The reverse split simply resets that look. It makes the share price cleaner and helps the fund operate smoothly. So that's the first real change, a structural reset. Not a strategy change, not an emergency, just a reset. But that wasn't the only update. If you look at ULTY today, the holdings inside the ETF are still built around a wide mix of companies. That's one thing that has always made ULTY different. It's not tied to a single stock. It spreads its exposure across many names, which helps reduce the impact of any one company moving up or down too sharply. This mix of companies creates a sort of balanced foundation. It's not a traditional index fund. It's not a simple stock basket. It's a strategy that blends exposure to multiple companies while generating income from options. Now, the interesting thing is that the mix inside ULTY tends to shift from time to time. Not in a dramatic way, but in small adjustments. This happens because the managers regularly update the positions to match market conditions. These changes aren't usually announced loudly, but investors can notice the effects based on how the ETF behaves. This is just part of how a strategy-based ETF works. So yes, the holdings inside ULTY have seen some small updates recently. Not a complete overhaul, not a reinvention. Just the normal evolution of an active strategy. Another change that many investors didn't notice at first is that ULTY's management structure was adjusted earlier. The team behind the ETF reorganized how the fund is overseen. This didn't affect how the ETF works day to day, but it does show that the company is committed to keeping the fund on track long term. When a provider makes internal management adjustments, it usually means they're trying to improve consistency, communication, or efficiency behind the scenes. All these updates, the reverse split, the small shifts in holdings, the internal management adjustment, reflect one thing. ULTY is settling into a more mature phase. Every ETF goes through a stage like this. The early excitement slows down. The structure gets refined. The fund starts shaping itself into what it's going to be long term, but there's more. Another recent change around ULTY is how people talk about it. When the ETF was newer, most conversations were about what it might do one day. People were wondering if it would become a popular high-income choice, or if it would compete with other trending ETF. But now, the conversation is different. Instead of what could ULTY become, people are asking, what does ULTY represent today? And the answer is clearer now than ever. ULTY is an option income ETF with a diversified base. It's built for regular payouts, not for chasing massive price swings. It's designed for steady exposure, not explosive growth. And it uses a structure that naturally shifts over time. Once investors started seeing it this way, the tone around the ETF changed too. There's less hype, but more understanding. People know this type of ETF moves differently from a regular growth fund. They know the price won't shoot up endlessly because option-based strategies cap the upside. They also know the fund will continue to adjust itself because that's how these strategies work. The reverse split made this even more noticeable. When an ETF resets its share structure, people pause and look at it again. They try to understand why it happened. They start reading about the strategy. They become more aware of what the ETF is supposed to do. That leads to another change, a positive one. which is transparency. After the reverse split announcement, more investors started checking official fund pages, reading updates, and paying attention to how these ETF operate. This type of engagement is good because it helps investors know what to expect instead of making assumptions. And if you're someone who holds ULTY or is thinking about it, here's the most important part. Nothing about the strategy changed. Nothing about the goal changed. The fund still follows the same idea from day one. The changes were structural, not strategic. So let's summarize the recent shifts in a simple way. ULTY had a reverse split. This is a structural reset to clean up the share price and keep the ETF easy to trade. ULTY's holdings continue to adjust as part of the active strategy. Small updates, nothing drastic. ULTY's management structure was refined. The team overseeing it strengthened how the fund is handled behind the scenes. Investor conversations changed. People talk about it more maturely now, understanding the nature of an income-based ETF. Transparency increased. More people check the official details instead of guessing. All of these things together shape the new ULTY. It's not a different ETF. It's the same ETF, but operating with fresh structure, cleaner organization, and a clearer market identity. But here's something else worth pointing out. These changes are part of what naturally happens when an ETF grows and evolves. It's not a warning sign. It's not a red flag. It's part of the normal life cycle of an option income fund. If anything, the reverse split signals that the providers are paying attention. They want the ETF to remain smooth to trade. They want the share price to stay at a level that feels natural for investors. They want the structure to stay strong for future adjustments. So the bottom line is this. ULTY is still ULTY. It hasn't changed its purpose. It hasn't changed its approach. It hasn't changed its design. What changed is the environment around it, the structure, the conversations, the attention, the long-term positioning. And honestly, that's a good thing. A fund needs these resets to stay relevant and stable over time. If you want me to cover what might come next for ULTY, or if you want a breakdown of its strategy in easier words, just let me know. If you enjoyed this simple breakdown of what changed recently with ULTY ETF, make sure to subscribe for more easy, conversational ETF explanations. This is Money Stick Unfiltered, keeping things simple as always. Catch you next time.